Right now, while you're watching stock tickers and arguing about elections, China is pulling money out of the US debt and moving it into gold and other real assets. If you do not understand what this means, you are the one who pays. Think of that 13 trillion as a pie with 13 slices, each about $1 trillion in IOUs on other countries. Roughly half that pie sits in dollar assets, United States government debt, agency bonds, and cash parked at big Western banks. A big chunk sits in euros and yen. Gold is still a smaller slice than bonds, but it has become the piece that matters most when people stop trusting paper. Here's the ugly part. If just 10% of those dollars get sold and moved into gold and other things you can touch, that is $700 to $800 billion trying to cram into a much smaller market. It is like pouring a swimming pool into a bathtub. It overflows, prices jump, and regular people pay for the mess, not the central bankers. That shift decides who gets stuck with higher food and energy prices, whose savings buy less every year, and which country calls the shots in the next crisis. Most people hear foreign reserves and picture a dusty room full of safe bonds. In real life, Beijing is selling down chunks of its dollar pile, buying more metal that does not care what the Federal Reserve does, and wiring up new payment routes that still work, even if Washington freezes accounts again. Your wage, your rent, your pension, the cash in your bank, the coins in your drawer, all sit on the side of the table that takes the hit when those dollars are watered down. In this video, I'm going to show you what they are selling, what they are buying, and how that can hit your bills and your savings, so you know if you are the one left holding the bag. If you want straight, data-backed breakdowns of how the money game is rigged before it hits your front lawn, subscribe, hit like, and turn on the bell. All right, take a breath. And let us talk about what reserves actually are, because if you do not know how the machine works, you cannot see how dangerous this shift really is. When people hear foreign exchange reserves, they picture a giant vault full of someone else's money. That is not how it works. A reserve is mostly a pile of government bonds and cash claims that a central bank can sell or pledge when it needs to defend its own currency or bail out its own banks. Here is where the story stopped being theory. In early 2022, after Russia invaded Ukraine, the United States and its allies did something that used to live in the category of they would never actually do that. They froze a huge chunk of the Russian central bank's reserves held in Western jurisdictions, roughly $300 billion plus. Overnight, assets that every textbook treated as the safest thing on earth turned into numbers on a screen that Moscow could no longer use. No bombs hit those accounts. No trader blew up the position. It changed because other governments changed the rules. If you are a big creditor watching from the balcony, that is the jump scare moment. You realize your own reserves are not a fireproof box. They are a permission slip that can be torn up if politics turn. Once you see that, you do not unsee it, and you start asking, what can they not freeze? What can they not cancel? Most people think a country simply sits on one big pile of safe United States Treasuries and calls it a day. In reality, there are two balance sheets that matter. The first is the public one, the official number that tells you how many dollars, how many euros, how many yen are on the books. The second is the shadow layer where those reserves are moved into other assets, often through state banks and sovereign funds, without making a big announcement. Let me break this with 3 quick lies about reserves that most people still believe. First lie, reserves are cash in a vault. In reality, they are mostly bonds and digital IOUs that live inside someone else's banking system. If that system locks up, your cash is stuck. Second lie, reserves are neutral and above politics. In reality, we just watch them get used like a financial weapon, and every large holder now has to price that in. If your savings can be frozen for reasons that have nothing to do with your own banks, that is not neutral. Third lie, a big reserve number automatically means safety. In reality, what you hold and where you hold it matters more than the headline total. A country with smaller but better built reserves can be safer than a giant who stuffed everything into one currency and one set of foreign banks. The same logic applies to your own balance sheet. Here's the key mechanic. When a country like China sells a chunk of United States Treasuries and buys gold instead, on paper they still have reserves. The total headline number can even stay around that familiar 3.3 trillion mark, but the character of those reserves has changed. One side of the seesaw is now tied to the credit risk and interest rate games of the United States. The other side is a lump of metal that does not pay yield, but also cannot default. Why does that matter for you, sitting at home with a normal job and a normal portfolio? Because your savings, your pension, and your cash flow live on the side of the seesaw that gets pushed down when governments choose inflation as their escape route. The people moving out of treasuries into gold are telling you which side they expect to lose. We need to talk about the simple math that is driving this, because it explains why this rotation is not a vibe. It is arithmetic. You have probably heard of the rule of 72. Normally, people use it to brag about investments that double. Divide 72 by your annual return, and you get how many years it takes to double your money. Flip it around. Use the same rule on inflation instead of returns. If your real inflation is 3%, that comfortable sounding 72 divided by 3 tells you your purchasing power is cut in half in about 24 years. At 6%, you lose half in around 12 years. Push it to 10%, and you slice your money in half in roughly 7 years. That is not a chart. That is your rent, your groceries, your savings, your retirement. That is your parents wondering why their pension suddenly buys less gas and less food. Now zoom out. Global debt is north of 300 trillion. That is debt stacked on top of debt, equal to more than 3 times global output. Politicians tend not to vote for explicit default. Voters will not tolerate explicit austerity for 20 straight years. So what is left? Quiet financial repression and slow currency debasement. Keep interest rates, in real terms, below inflation for long stretches, so the debt erodes. Savers eat the loss while the system crawls forward. That is the game. China understands this better than almost anyone because they are sitting on one of the biggest piles of claims in the system. They are not waiting around to see which currency loses the race more slowly. They are already moving into the one thing that sits outside that game. Let us start lining up some numbers so this does not sound like a story. It sounds like what it is, a slow-motion balance sheet shift. As of the end of 2025, China's official foreign exchange reserves are a little over $3.3 trillion. Out of that, the reported holdings of United States Treasuries have slid to roughly $680 billion, the lowest level in well over a decade. A decade ago, that number was well above $1 trillion. Let that sink in. We are talking about a cut of hundreds of billions in exposure to United States government debt. At the same time, the central bank in Beijing has been buying gold in nearly every quarter since late 2022, adding hundreds of tons in total. Officially, Beijing reports a little over 2,300 tons of gold, which already makes it one of the largest official holders in the world. Some analysts believe that once you add metal held via state-owned banks and sovereign funds, China's true holdings could be significantly higher, but those estimates are debated and not officially confirmed. Here is what that means in plain language. Every time they move another 100 tons of gold onto their side of the table, they are converting roughly several billion-in-dollar claims into something that sits outside Washington's control. It is a swap from, we trust your bonds, to, we trust this bar of metal more than we trust your politics. And this is not just about stacking metal in a vault. This is about building an exit ramp away from the dollar-based pipes that have run global trade for roughly 80 years. We need to talk about Project mBridge. If you have never heard of it, that is exactly the problem. While everyone on social media argues about meme coins, China and a cluster of partner central banks have been test driving a new cross-border payment platform that runs on central bank digital currencies. As of early 2026, that pilot has pushed more than $55 billion worth of transactions across borders. The vast majority of that volume is in a digital version of the yuan. Payments settle in seconds at lower cost than the old SWIFT messaging rails. That is not a white paper. That is live traffic. Most people think the dollar only dies if some dramatic announcement comes out that the United States has been replaced overnight. In reality, this is how it actually happens if it happens at all. Side channels like mBridge quietly grow until enough trade can clear outside the old system that countries can say, you know what? We do not need to route everything through New York anymore. Now connect the dots. On one side, you have a steady seller of United States Treasuries and a steady buyer of gold. On another side, you have a new payment rail where trade partners settle directly in their own currencies or in digital central bank money. Put those together and you get the outline of a world where you do not need to hold as many dollars as insurance to trade. If the demand for dollars as plumbing falls, the ability of the United States to issue infinite debt without market consequences also falls. So who is the villain in this story? It is not a cartoon bad guy. It is a structural incentive that sits across governments and central banks. The villain is a system that has promised more than it can mathematically repay, and now needs a quiet way to shrink those promises in real terms. The way you shrink promises without saying it out loud is simple. You keep interest rates below true inflation, and you let currencies slide. What does that system gain? Time. Political breathing room. The ability to say, we honored our debts while paying them back in money that buys less. What do you risk? Your savings, your wage power, the real value of the assets you thought were safe. China is not a hero here. They are just earlier to the exit. They are moving from being the biggest customer of United States debt to being a big customer of the one asset that has survived every paper experiment so far. They watched what happened in the 1930s when the United States grabbed domestic gold and revalued it. They watched what happened in the 1970s when the dollar was cut loose from gold and the metal went up more than 20 times in less than 10 years. They can read a chart. And it is not just central banks. Chinese households are some of the most savings-obsessed people on Earth. For years, they accepted low returns on bank deposits because there were not many alternatives. Now, with many household deposit products paying around 1% or less, while real-world costs for things like housing and essentials still feel heavy, you are seeing a steady leak of savings into gold bars, coins, jewelry, and into other hard assets. When normal people in a major economy quietly decide, I trust this coin more than this savings account, that is not noise. That is a referendum on the currency. So where does this leave you? Sitting there with a portfolio that is probably 90% or more tied by the ankle to the dollar and to other paper currencies that are being managed the same way. You cannot control what Beijing does, you cannot control what the Federal Reserve does, but you can decide which side of this slow motion transfer you want to be on. Towards the end of this video, I'm going to lay out 3 very specific positioning moves I am personally making in this environment. Before we get there, I want you to see how financial repression actually feels from the inside, because once you notice it, you cannot unsee it. On the surface, this sounds like central bank drama. Underneath, it shows up in very boring, very painful ways. When your bank pays you 1% on savings, while your real-world costs quietly climb at 4 or 5%, that gap is not bad luck, it is policy. Year after year, a slice of your future spending power is shaved off to make it easier for governments and big borrowers to live with their debts. Pension funds are built on the same math. They buy long-term bonds based on assumptions about inflation and interest rates that were written in calmer times. If long-term inflation runs higher than those old assumptions, the promises on those glossy pension statements become harder and harder to keep in real terms. When the biggest creditors in the system see that setup and start shifting out of long bonds and into hard assets, the bill does not vanish. It gets handed to whoever stayed fully exposed. Imagine you keep a chunk of your savings in a simple deposit that pays 1%. Inflation in your real life, not the number on a press release, runs at 4 or 5% once you factor in rent, energy, and food. On paper, your account grows. In the supermarket, your buying power shrinks. Over a decade, that quiet gap compounds into a very real pay cut on every dollar you saved. Most people think of inflation as occasional price spikes they complain about. In reality, when governments are buried in debt, inflation is a policy. It is the least honest way to default. Instead of saying, we cannot pay, they pay you with money that has been hollowed out. The longer you sit only in cash and bonds in that environment, the more of the cleanup bill you quietly eat. That is why central banks, on net, have been buyers of gold at these levels, not sellers. It is why a country sitting on more than $3.3 trillion in reserves is cutting United States bond exposure and upping its metal. They are not doing that because they love yellow rocks. They are doing it because they know how this movie usually ends, and they want a different seat this time. All right, let us talk about the 3 kinds of moves that make sense in a world where the biggest players are rotating from paper promises into hard assets. This is not investment advice. I am not your advisor. I'm telling you how I think about it for myself, so you do not walk into this blind. First, the foundation. Direct exposure to physical gold. Not as a trade, as insurance. When you hold a reasonable slice of your net worth in actual coins and bars, not in a promise on a brokerage screen, you are doing the same thing central banks are doing, but on a human scale. You are taking a piece of your savings and moving it out of the game of what will rates be next meeting and into something with 5,000 years of history of not going to zero. Does that mean you dump everything and live in a vault? No, it means you think in percentages. As a personal framework, I think in ranges like 10 to 20% of investable assets in physical metal. But the right number for you could be very different, and you should talk to a qualified professional before making any big allocation changes. The goal is not to get rich off the metal itself. The goal is to have a chunk of your balance sheet that does not depend on anyone keeping a promise. Second, the offensive play. Exposure to quality gold and silver miners. This is where the asymmetry lives. When the underlying metal price climbs, the profits of a well-run mining company can expand by a multiple of that move because their costs do not rise nearly as fast as the sale price of what they dig out of the ground. That is why in past metal bull cycles, you have seen miners move 10 times or more while the metal only triples or quadruples. The catch is that this is a part of the market where you cannot be lazy. You do not buy any ticker with gold in the name and call it a day. You look for producers with low all-in costs, solid balance sheets, and projects in countries that are not going to wake up and slap a surprise tax on them. Think places like Canada, Australia, and select parts of the United States. You size positions so that if volatility hits, you can stay in the game without panic selling at the bottom. Third, the structural hedge. Diversifying part of your life outside pure dollar exposure. That can mean holding some of your metal in storage outside your home jurisdiction. It can mean exploring assets and other stable currencies. It can even mean holding a modest slice of non-sovereign digital assets that have hard caps on supply. The theme is the same. Do not let one political system, one central bank, one currency be the single point of failure for your future self. And this would not be the first time the rules of the money game flipped on people who thought the old setup was permanent. In 1971, when the United States closed the gold window and stopped letting foreign central banks turn dollars into metal, a whole generation of policymakers overseas discovered that the agreement they thought they were living under had just changed overnight. The dollar stayed, but the terms were different, and gold went on a historic run as the system repriced. In the late 1990s, during the Asian financial crisis, several countries burned through large chunks of their reserves trying to defend their currencies, and still watched their exchange rates collapse. Big headline numbers did not save them because confidence and structure mattered more than size. Every time the rules shifted like that, the people who came out the other side in one piece were the ones who owned real things and were not all in on the old promise. Here's how I think about the scenarios from here. You're basically looking at two main paths with a lot of noise in between. Path 1, the market muddles through. The dollar stays dominant longer than anyone expects. Financial repression continues, but it is slow enough that most people just feel vaguely poor every year without a dramatic collapse. In that world, owning some gold and miners and non-dollar assets may simply mean you underperform a hot stock index some years and outperform in others, but you sleep better at night. Path 2, something breaks louder. Maybe it is a funding crisis in the bond market. Maybe it is a geopolitical shock that accelerates the move onto platforms like mBridge. Maybe it is a loss of confidence in the ability of major governments to roll their debt forever. In that world, the repricing of currencies against gold and other hard assets can be fast and brutal. If that happens, the people who treated gold and related assets as insurance, not as a casino ticket, will already be positioned while everyone else is trying to buy at panic prices. I cannot tell you which exact year the big move happens. Nobody serious can. What I can tell you is that ignoring this rotation from paper promises into hard assets is a choice, and it is a choice with consequences. 6 months from now, a year from now, or 5 years from now, you will look back at this window as one of those quiet pivot points that only becomes obvious in hindsight. You will either say, I saw one of the largest creditor nations on earth changing how it holds value, and I adjusted. Or you will say, I assumed the old plumbing would work forever, and I left everything tied to it. Do not be the exit liquidity for a system that is already telling you, through its own actions, that it plans to pay you back in weaker money. Do not be the person who stays 100% in paper claims while central banks buy metal hand over fist. Do not wait for a press conference to confirm what the balance sheets already show. If this breakdown helped you see the pattern behind the headlines, do me a favor. Pause for a second and type in the comments what share of your portfolio is currently in gold, silver, or other hard assets. And what is stopping you from increasing that if you feel underexposed? Is it lack of knowledge? Is it trust? Is it the fear of missing out on stock gains? I read those, and they shape what I cover next. Then subscribe, hit like, and share this with one friend you know is worried about where the system is headed, but feels stuck between panic and denial. This channel exists so you do not have to navigate this alone. And so you have a community of people who refuse to be surprised by changes that were visible in the data all along. You cannot control the choices that central bankers and governments make. You can control whether you stay on the side of the trade that is getting hollowed out, or whether you quietly shift part of your life into assets that have a track record older than any modern central bank. Make that decision with your eyes open. Your future self will thank you.